Hi, this is Steve Hutchinson with Hutchinson Family Offices, and I want to give you a special greeting for this month's video as we conclude the summer. It's finally over, and now we're going to settle down to business. Well, we're about 2 months away from the general election, and governor elections, presidential, everything is going to dominate the news. People are going to be trying to glean as much information from what someone said, he said, she said, and try to dictate that towards our economy. We like to ignore the noise. Elections have been around since the Constitution was written, and they'll be around far beyond our lifetimes. So the bottom line is the elections are the elections. They're important. Campaign for your candidate and get out and vote. But let's talk about the more important issues, your money. Now, I'm going to talk about the financial markets, interest rates, and our economy. Let's talk about the financial markets first. As we finished up earnings season, the financial markets really just fizzled. Well, we didn't see much. We saw a negative growth in corporate earnings and revenues were flat. This does raise some concerns because as we move into the fourth quarter, generally speaking, sometimes fourth quarter earnings are stronger than the third quarter, but we don't expect them to see much change. So we're keeping our eye on this very closely. We believe September will be a very difficult month as market expectations are tempered. Generally speaking, September is one of the tougher months in the financial markets. But coupled with a slowing economy, a decline in employment, and of course incomes aren't growing, we don't expect much out of the stock market in the fourth quarter. Although we may get a nice bump up and someone on the news will say we've hit an all-time high. I remember those all-time highs, we've hit them several times before. We're really looking for a close in the S&P 500 above 2,200 with some very strong volume to say we're back on the bull race again. Now, we remain cautious and continue to hold higher than normal cash positions. This isn't because we think the market's subject to an immediate correction or a pullback. It just means that at these levels, we're less likely to commit to companies where valuations appear a little high to us, although price targets seem to be in focus. So we're sitting back on a little bit more cash than usual. Now, the employment picture continues to disappoint. Last month of August, our employment report showed 121,000 jobs in the private sector. Now, I've talked about employment month after month, and I've said employment numbers are very, very worrisome. And the reason being is because we're not seeing significant growth in broad-based manufacturing or jobs that are paying above the norm. Now, we do have some issues that may be coming up in December. There are some Department of Labor rules that are going to be coming out December 1st regarding overtime. We do expect that to create a little bump up in December in wages as companies adjust payrolls for that adjustment as far as overtime is concerned. But generally speaking, we're not seeing incomes go up, and that does concern us. We do believe that the lack of job growth is going to slow our economy, and it's going to pull the economy back or keep it at or near where it's at today. Now, speaking of economic growth, the numbers are due out soon. So what we're really expecting at this particular point is a slow to meddlesome, middle of the road type of economy. We're not expecting very much at this particular point, but we do expect a continuance of growth. We are not looking at a recession, although there possibility exists, but right now we don't believe that a recession is really on the table. Let's finally talk about interest rates in the Federal Reserve. I know I sound like a broken record, and we have for months on end put out our videos and said we do not see the Federal Reserve increasing interest rates. If you read the financial news, internet, whatever it may be, you listen to the talking heads on TV, they're always talking about interest rates and trying to quantify that position. The Fed is data dependent. We don't believe they're going to increase interest rates in the September meeting. There is a possibility that we may see a token increase in December, which would pretend maybe I'm in charge, I can really do this because I want to. But really, to be very honest, there is no data that indicates to us that the Federal Reserve should even consider an interest rate increase. So for right now, we believe the Fed will remain constant. Now finally, I want to talk about an article I read recently on our nation's debt. And as I went through this information, I read it on Barron's, this week's Barron's, and it does raise a lot of concerns. And I believe this is one of the issues that we're going to start addressing sooner than later. We're starting to see our debt being pressured not only just by our interest payments, but basically underpinnings of our spending are starting to be tempered, and we're having to borrow more and more money. So remember, if the Federal Reserve increased interest rates, even by 1/4 of a point, it's going to raise the cost of borrowing money to pay for our government. So the debt issue is a concern. It does hamper the economy. Now, we still see continued growth in selected sectors of the economy. We're very favorable with real estate investment trusts. We think certain sectors of real estate look very positive right now. Some consumer companies look very strong. We think as we move into the fourth quarter, some consumer-driven companies, some of your standards will perform very well. We also believe that technology is going to continue to push forward. We also believe that U.S. markets are stronger than our international counterparts, and we believe that the risks internationally will continue to elevate. Now that's it for this month's video. Have a great fall, and we'll be talking to you soon.